The Intelligent Investor is written by Benjamin Graham in 1949. It's possibly that the most important, influential, value investing book ever written, a Bible for the all investor. It made the concept of investing simple and easy to understand, so that an ordinary individual could become an intelligent investor. The book is also famous for introducing two concepts into the investing profession: the allegorical Mr. Market and the concept of margin of safety. Warren Buffett described it as by far the best book ever written on the investing. Key takeaways: investors are two main types, the enterprising investor and defensive investor. It is important to understand the difference between the speculation and investing. Enterprising investors should treat investing like business and commit their time and energy to same. Most important, don't have the time to see investing as a business. Hence, they must follow defensive strategy. There is no evidence to suggest that market timing and forecasting work. Value investors must focus on the operating performance and dividend of the firm they own rather than the changing stock price. When measuring value, check the firm earning ability, then multiply the adjust the assessed value. Shareholder must check the reliability of management. Shareholders are reasonable for ownership. They also have certain rights. Hence, stockholder must employ them seriously and consistently. Always employ a margin of safety to limit your downside. We, an intelligent investor, understand the difference between the investing and speculation. The intelligent investor is one of the patient, disciplined, and eager to learn. They also able to harness their emotion and think of themselves. The kind of intelligence is a trait more of the character than of the brain. The first step toward being an intelligent investor is understand the difference between the investing and speculation. Investing entails a thought analysis of an investing that include the determine the risk, return, and characterize of the asset. An intelligent investor has ability to promise safety of principal and adequate return. Speculation, on the other hand, involves take investing decisions that are not made on a foundation of research and analysis, can consequently lead to high probability of loss of capital. Investors should limit their allocation to speculative position, also known as made money account, to no more than 10% of the investing fund. Never mingle the money in the speculative account with the money in the investing account. Stocks do well or poorly in the future because the businesses behind them do well or poorly, nothing more and nothing less. The intelligent investor will never exit a stock position poorly in the response to share price movement. She will always first ask whether the value of company underlying business has changed and they react accordingly. The intelligent investor only pay attention to current stock price when it suits him. The investor who permits himself to worry by unjustified market decline in his holding is essentially transforming his basic advantage into a basic disadvantage. The speculators may interest to anticipate and profit from the fluctuation in the market. The investor's primary invest is to acquire and hold suitable securities at the suitable price. Investing is not about betting other their game. It's about controlling yourself at your own game. Most investors fail because they pay too much attention to what stock market is doing currently. Stock market volatility and introduction to Mr. Market concept. Imagine that we own a small share in a private business that costs us $1,000. One of our partner is called Mr. Market. Mr. Market is a very obliging partner every day. He tells us what he thinks our interest is worth and furthermore offer either to buy us out or to sell us an additional interest on the basis. Sometimes his idea of value appearing justifies and plausible by business development and prospect as we know them. Often on the other hand, Mr. Market lets his enthusiasm or his fear run away with him, and the value he proposes seems to you a little short of silly. We are a prudent investor or a sensible businessman will we lot Mr. Market daily communication determine overview of the value of $1,000 interest in the enterprise. Only when we agree with him or we want to trade with him, we may be happy to sell out him when he quit a ridiculously high price and quality happy to buy from him when his price is low. But the rest of time we would be wiser to from our own view of the value of our holdings based on full report from the enterprise about its operation as well as its financial positions. Inflation, the silent weather. Inflation is real and it erodes our purchasing power over time. A dollar 10 years ago is worth more as compared to a dollar today. What means is that cash is treble investment. We need to make use the cash to get more cash. We need to invest cash beat inflation. Investors often overlook the importance of inflation. Psychologists call this the money illusion. For example, we receive 2% raise in salary in a year when inflation runs at 4%. We will most certainly feel better than if we take 2% pay cut during a year when inflation is zero. Yet both changes in the above mentioned scenarios leave us in a virtually identical position, which is 2% loss after inflation. Investing in stock for the long term and REITs can help investors guard their earning investing return from the ill effect of inflation. What type of investor should you be? It is widely believed that the return you can expect from an investing is directly proportional to the risk that you are willing to take. This vigorously translates into the belief that high risk equivalent high return, while low risk equal low returns. However, the rate of return that an investor can expect is not only a function of risk but also of the amount of effort he/she is willing to invest in the research. To determine that amount of risk you can take, ask yourself, are you single or married? What does your spouse or partner do for a living? Do you or you will have children? Will you the tuition bills his home? Will you inherit money or you will end up financially responsible for ailing parents? What factor might hurt your career? If you work for a bank or home builder, a jump in the interest rates could put you out of a job. If you work for a chemical manufacturer, soaring oil price could be bad news. If you are self-employed, how long do business smaller to year tend to survive? Do you need to invest the supplement your cash income? In general bond will stock want. Given your salary and your spending need, how much money can you afford to lose on your investment? For the defensive investors, high-grade bond and common stocks. The defensive investor should divide his fund between the high-grade bond and high-grade common stock. The standard division should be equal ones, 50-50 between stock and bonds. A sound reason to increase the percentage in the common stock is when there are more stock in a bear market at bargain price. Conversely, they should reduce common stock component to below 50% when the market level has become dangerously high. Investing in the investment fund is more suitable for the defensive investor. Stock selection for the defensive investor. Number 1. Educate the size of enterprise. Equate small companies that are more volatile. Number 2. A sufficiently strong financial condition. Current assets should be at least twice of current liabilities for the industry's firm. Long-term debt should not be more than net current assets. For public utilities, the debit should not exceed twice the equity. Number 3. Earning stability. Posting earning for each of the past 10 years. 4th. Dividend record uninterrupted for the past 20 years. 5th. Earning growth, a minimum increase of the least 1/3 in the per share earning in the past 10 years, using 3 years average at the beginning and end. 6. Moderate price to earning ratio, no more than 15 times average earning of the past 3 years. 7th. A moderator ratio of the price to assets should not be more than 1.5 times to book value last reported. However, a low PE ratio below 15 can justify a high price to book value. PE ratio x PB ratio should not be more than 22.5. Stock selection for the enterprising investor. Number 1. Financial condition. 1. Current assets at least 1.5 times current liabilities. And 2. Debt not more than 110% of the net current assets for industrial companies. Earning stability. No deficit in the last 5 years. Number 3. Dividend record, some current dividend. 4th. Earning growth, consistent earning growth. Number 5. Price less than 120% net tangible assets. It is important to note that many of best professional investors first get interested in the stock when its share price goes down, not up. Looking at the daily list of new 25-week low can be a great way to get started. Portfolio policy for enterprising investors. Number 1. Buying in low market and selling in high market. Enter the market during period of desperation and exit in the advantage stage of boom. Number 2. Buying carefully chosen growth stock. A growth stock may be defined as one that has performed better than the average in the past, is expected to do so in the future. Number 3. buying bargain issue of various type, usually created by one currently disappointing result and second protected neglect of the unpopularity. Number 4. Buying into special situation. For example, buying potential equation target, usually smaller companies. Number 5. Buying a relatively unpopular largest company. While smaller growth companies can be trading at an extremely high multiple, large companies may be trading at super low multiple due to current unpopularities. Advantage of large companies are that they are more stable. Investment selection. How to analyze stock and bonds. When analyzing bonds, the most important criteria to take note of the number of times that total interest charges have been covered by available earning. We should analyze for at least 7 years in the past. 4. Preferred stock. It is the number of time bond interest and preferred dividend combined have been covered by the available earning for 7 years in the past. 4 stocks. We have to compare our valuation of the companies to the current price that company is trading at in the stock market. We should always seek margin safety, purchasing the stock for less than the intrinsic value. The lesser the assumption we have to market about the future during the analysis, the lesser to the possibility for error. Avoid making too many assumptions in your stock analysis. Element to determine how much the enterprising investor should to pay a stock. Number 1. Long-term prospect of the company. Gather evidence in the financial statement that answer 2 questions. What make the company grow? Where do and where will its profit come from? Look for companies that. Number 2. Have a wide moat of competitive advantage. Number 3. Prefer to run marathon, not sprints. Number 4. Focuses on what is solving. Number 5. Management competency. Look for management that says what they will do and does what they have said. A good management will admit failure and take responsibility for them. Number 6. Financial strength and capital structure. A good business generates more cash than it consumes. See in the statement of cash flow whether cash from operation has grown steadily over the past 10 years. Number 7. Dividend record. One of the most persuasive tests of high quality company is an uninterrupted record of dividend paying going back over many years. 20 years is preferred. Number 8. Current dividend rate. 9. Be a long-term thinker. Looking at the longer term provide a better indicator of the future health of company. Number 10. Look into the footnotes. Be wary of aggressive revenue recognition practices. It is a sign of dangers that run deep and large. Also be wary companies that do not charge expenses against the revenues when it is suitable to. Instead, that they treat this expense as a capital expenditure that increase the company total assets instead of decreasing net income. The margin of safety, the most important concept. The margin of safety in stock investing is difference between the intrinsic value of company and price we pay to purchase it. The amount of price paid is the most important factor in the investment. Determining the purchase price and having the discipline to only buy at below the price is where the true test lies at. A sufficiently low price relative to actual value can turn even mediocre quality stock into a great investment opportunity. The greater the margin of safety, the more leeway we have for things to go bad before we lose money. If the future is a we expect it to be, the profit generated from the investment will also be much higher. Unfortunately, not many people in the world can make an accurate forecast into the future of company, and there is always a risk of paying too high. The reason for having a margin of safety is essentially to make an accurate forecast of the future less necessary. There is a buffer to inaccurate forecast. One of main reason for investor loss is that they buy low quality stock at the time of favorable business condition without a margin of safety. Diversification is a key of component of margin of safety. The odds would be with us when we only invest in individual stocks with a large enough margin of safety, while some stock will lie on to over expectation, many other will not. Diversification can amplify the benefit of margin of safety. A diversified portfolio has high profitability of generating above average returns. 11 rules that can help both analysts and investors. Estimate the earning capacity of a company to measure value, multiply that correctly and take into account asset value. Earning capacity is an estimate of the firm's earnings over the next 5 years. Guess a firm's average earnings over the period. You can do this by averaging past performance, then estimate margins and revenues for the future. Adjust previous year numbers to reflect any changes in capitalization. You should use a maximum multiplier of 20 and minimum of 8. This allows for changes in earning in the long run. If the value arrived at the firm earning power is higher than the fixed assets value, subtract from the earnings value changes. Subtracts a quarter of sum by which is earning power value is higher than 2 times the asset value. This allows for 100% premium on tangible assets since penalty. If such value is lower than the net current asset value at 50% of the variance to the value measured on earning power. In usually events like war, short-term royalties or rentals, adjust the value accordingly. Assign value among bondholders, stakeholder or preferred shareholder before the step. Compute the company value as thought is capital structure had only common stock. The more debit and preferred stock in the capital structure, the less you need to rely on appreciate value. Decision should not be taken based on this value. When the appraisal is 1/3 greater or less than the current market value, you can base your decision on this. If the difference is less than appraisal is just factor to consider the assignment. And always remember, investment is most intelligent when it's most business-like. When we buy a stock, we become an owner of the company. Value investing is definitely a great approach to creating long-term wealth. However, value investing also requires a significant amount of commitment from your end. You need to study a company, arrive at its true or accurate intrinsic value, and then identify the best opportunity to buy that stock, i.e., when its price is below its intrinsic value. If you already have full-time job or don't have the inclination to invest your time and energy in the such analysis, then you might be better off investing in mutual fund. Basically, mutual fund are investment vehicle. They pool investor money and then invest in different assets, cases like equity, debit, gold, etc. Within equity investing, certain mutual fund schemes follow the value investing approach, wherein the fund manager along with the investment team use the value investing methodology to identify stocks that are trading at the deep discount in their market price and thus have a good margin of safety. And additional benefit of increasing thought mutual fund is that they also give you opportunity to diversify your portfolio, thereby reducing overall portfolio risk. From the perspective, they can help you because value investor without having to take that effort to analyze a stock, determine to buy a price and track it till you reach the best sell price. And investor education initiative. All mutual fund investors have good through to one-time KYC process. Investors should deal only with the registered mutual fund RMF. For more info, KYC RMF and procedure to launch. How do you feel our effort for the creating this video? If you really like our effort, please do share and subscribe our channel and also like this video. So we will meet next video. Till then, bye bye. Thank you for watching.